Hello, ladies and gentlemen, and welcome back to a special weekend edition where we take a look at the stock, commodity, and crypto markets around the world and deep dive into the key levels that you need to be watching. As many of you know by now, we're heading into earnings season. This is the first big week of earnings, including large banks and also Netflix, Tesla, and many more. So will the SP 500 be able to break through and start a bit of a run? And then the question becomes, is that run more of a bull trap? Well, we have some great statistics and macro information today that'll show you that what this may seem to be could be the exact opposite. A lot of people can't understand how markets can go up on bad news. Inflation's so high. Well, it's all got to do with the traps and the games in the markets. And today we'll try to break it down, and hopefully most of us will have some better idea by the end of today's video. Stay tuned, guys. This is going to be a very good one. See you soon. Well, welcome back everyone to the daily show where we talk about stocks, commodities, and cryptos. If you like any of those markets, remember to subscribe and of course, smash the like button if you enjoy our content. Let's talk about sentiment. So right now, it's pretty clear that a lot of people are bearish in markets, but that switched a little bit last week. So people have been more bearish. On the 22nd of June, everyone was bearish in the market. This is the retail survey generally. 59.3% of people were bearish, only 18.2% were bullish. That switched on the survey from the 13th of July. We went to 26.9% bullish and 46.5% bearish. Now remember, historical averages have a lot more bulls, a lot more neutrals, and a lot less bears. So once that starts to change, sometimes you need to be careful about how everyone's perceiving the markets. Things are dangerous out there. We know that there are stacking of shorts occurring from the street. And this chart really details that. You'll notice here the trend that's been going on, but more importantly, the trend that went on around April or around March into April, and the trend that's currently occurring. As this market's ramping, people are dumping positions. These are larger players. Larger players are dumping positions and starting to add to shorts. Now, for anyone that knows how shorts work in markets, this is actually very, very normal. And the more we see this happen and the more it goes up and the more they start to short, the more you need to start worrying about a bull trap. And we'll talk about that further in today's video because it's very important. Now, for investors out there and people that don't trade, sometimes you want to look at insider big block trading. And the reason why I want to bring this up is because, yes, we're actually getting a signal that shows that this is one of those times that often, historically speaking, is a good investment point. You can see here through history, it's often correlated with lows in markets. And I've used this many, many times and it's been pretty damn good. The only problem is, notice 2008. The signal that it gave did lead to a rally, but it turned out to be a bull trap where the market then moved down. So if we're heading into a recession, which many people already believe we're going into, I think we've got about 43% of all yield curves inverted. So that's not really the best thing in the world. Then effectively, we could be moving further down. Remember, the average recession drops back around 32%, which we'll talk about soon. But yes, inside of big block trading, in general, there are a lot of purchases happening. And this seems to be from some of the smarter players out there. So conversely, we've got the shorter time frame leverage traders. They're trying to short the market or at least add into shorts. We've got the big block insider traders adding to longs, but they're looking at obviously a lot longer time frame. And we've kind of got like a clashing of ideas right now. For anyone that hasn't been watching the channel so far, we've been talking about future yields. A lot of people don't know that yields are going to go up pretty heavily. I mean, most people probably know by now, but they don't know it's 3.6%. So it's expected to reach 3.6% by early 2023. And then the bond market at the moment is telling us that there's going to be rate cuts after that point. We don't know that's going to be true, but that's certainly what the market's telling us. So is it time to freak out? Is it time to say, well, hey, we're going into an 80% crash? I don't think so. And that's my personal opinion. Obviously, I'm looking at all the facts and figures. I still think the markets can go lower, and we'll talk about that soon over the medium to, kind of like next year. But basically speaking, this is one of the factors that a lot of people point to. And I just want to bring it back up. US household net debt. It's not anywhere near as bad as it used to be. And this is very important because when net debt was really, really high, that's what, of course, ended up being the problem, where we saw the subprime mortgages. We obviously saw the big crash in property in the US, and that led to the GFC. It's a little bit, this time it's different. Like a lot of people hate that comment, but it is in some ways. There's a little bit better cash padding for some of these potential rate hikes. Another thing that people are looking at just as an early indicator or an indicator of bottoms is US Empire State Manufacturing, new orders 6 months ahead. Often it will bottom near the end, and you'll notice that they were very similar lows from both the tech bust and the GFC. So some people have sent me this and just wanted me to share it with you. I'm not sure if I use it that much, but certainly there if you're interested. So where's the inflation now? Have we hit the top of inflation? Well, it probably has hit the top. And the reason why is because we know gasoline has actually dropped. So we know since this reading on gas, it's basically dropped off. That's because US oil has dropped and has started to curb. Airfares were already heading down. Of course, they're kind of linked to gasoline. So if gas is coming down, then airfares should also come down. Maybe demand's lowering there. Household energy, I'm not sure about everyone else in the world. You can let me know in the comments down below. That's skyrocketing here in Australia, that's for sure. But in other countries, it's going up at a very fast rate. Transportation probably stays fairly similar. And when you start going through some of these things, new vehicles, you could make the case that metals have started dropping. That's going to hit the supply chain soon. Maybe they drop or at least stagnate a little bit now. And then, of course, hotel rooms, well, that's up to those people. But I want to point out used vehicles. When you raise rates the way that the Fed is going to, there's no way that this is going to stay high. It's going to continue to drop. And it seems like this is the most likely scenario. Used vehicles will drop, medical, school, all of those other things, they're probably all going to stay relatively high. But I think there's a good case to be saying here that a lot of the components of an inflation report are starting to drop or turn around, and that while this is the lagging report, remember, so we're already seeing it manifest in price. The market knows this, of course, but a lot of people just look at the number and they can't predict it. Gas certainly should be on the downtick. It just makes sense where US oil is right now. Let's talk about earnings. So we're in earnings week. It's banks, and banks so far have been a bit muddled, not necessarily very good. We've got Bank of America before the open, Goldman Sachs, Charles Schwab, of course, and then we have a whole bunch of other banks throughout the week. But we also have the kickoff of the tech stocks this week. Remember all those months ago when Netflix had the bad return? Will it have a bad one again? Might be time to get out the Google codes and start searching the trends there, guys, if you like Netflix. But basically Netflix after the close Tuesday, that's going to be a big one. Tesla then after the close Wednesday. I'd be surprised if Tesla doesn't go okay, but maybe the Shanghai slowdown has really stopped them. I'm not too sure. Snap over here, and then of course we've got American Express and others. So I think these two big techs are going to kick it off, and it's the week after this week that's going to be the big one. That's when you've got your Apples coming out. You've got everything else really releasing. And I think a lot of stocks are going to try to hold their way up until those big ones release. And then things could turn very sour very quickly. Let's have a look at S&P 500s during recession drops. As we know, if we enter a recession, on average, recessions drop 32% in the US. That means the S&P 500 would have another 10-ish% down from where it is currently to 12%. And it's the expectation that a lot of people have. I've noticed a few people now sending out these types of things where they're giving levels and saying, okay, at 3,600, we take a nibble. At 3,300, we take a bite. And at 3,000, we gorge ourselves. What a way of adding your investments. But PE multiples here are really what they're talking about. Forward PE. Now, this is not necessarily the best way of looking at things. I think most people know that PE is based, or forward PE is based on current expectations. Now, if those expectations drop, which they generally do during recessions, you can't really use these multiple numbers that well. It just depends on how bad the recession is. But of course, in this case, it would still be very, very interesting levels. And I think we've talked about it a lot. 3,200 and 3,000 are where many big bond managers believe the market is going at some point over the next 6 to 8 months. Will it happen? Well, we did a quick poll survey of this on the community, and most of you thought around 34 to 32 was pretty probable. A few of you had 4,200 by the end of the year, so we'll see who's right there. Differing opinions, that's how the markets work. Let's move over to copper. Copper, or Dr. Copper as we know it, tells us whether really there's a sickness in the economy. Right now, there is a sickness. I've been doing some studies on, obviously, the China housing situation. And I'm not coming back with anything good, by the way. It's pretty bad over there. I still think it'll be held, but people are refusing to pay their loans. People are refusing to really buy stuff anymore because a lot of the way they work on is you pay multiple years before anything's even built. So it's even started being built. You're already paying off the mortgage. And there's a whole bunch of problems there. But I do think the government will come in and step in and probably try to fix the stopgap for now in that situation. But a big lead on to why this is so bad is the housing issues in China. It's not just America. It's not just the other countries in the world. It's a lot to do with China, this stat here. And it does show an economic slowdown across the board, which could have large ramifications. And if the straw broke, let's say in China, it would be absolutely astronomical. Like the fallout from that would cause some kind of GFC. So you have to watch that situation. Hopefully we can stay on top of it. Hard to get good information out of there. We'll continue to cover the situation as it unfolds. Let's move over to the US 10-year. As you notice here, we've got around 2.7% being a huge level of, I guess you would say, buyers coming back in for this this yield. And we're wanting to see this drop. The US 10-year, we want to see it drop. Problem is, while the US 10-year is dropping, which technically can buoy stocks a little bit, what it's telling you is it's at 2.9%. The US 2-year is at 3.12. So they're very heavily inverted. Usually, if this starts to drop, these yields here, then the market can find some kind of recovery at the moment. But it also has got to do with huge amounts of sickness in the market as well. So there's so much correlation going on there. The better reading is using the US dollar instead. We saw the dollar drop through the Friday session. And guess what happened? Stock market ramped up heavily. Now, a lot of people can't understand how can the stock market go up bullish while the markets, everything looks so bad. It's all got to do with trapping, guys. Remember, most people are bearish on the market at the moment. Almost anyone you talk to is bearish. It's time for the bull rally to kind of come through to trap people. And as they're trapping people, then they can push the market up and add to the shorts. That's why it's so important that you continuously watch channels like these so you can get those short numbers coming out. And if they keep adding shorts and the market keeps going up, you got to start to say, well, these aren't adding up. So maybe a big fall is about to happen. Be very, very careful on those. US dollar did weaken here, which is kind of a good sign. It's probably in excess at the moment. So what excess means is that if you look at it on a weekly chart, it's kind of too far away from a lot of indicators. If you add moving averages to this, the chart's just gone vertical and the moving average is kind of sitting here. That means it's time for mean reversion. A good way of adding mean reversion is to add a moving average, to put on something like a 20 moving average here. So we'll just do that together right now. Guys, here we go. We'll add the red and put the 20 moving average on. And then you can see here the weekly, look how far away we are from it. We've been a long way away for a while. Let's go to a daily 20 moving average. See how far away we are and see how it's come back multiple times. This type of mean reversion is very common. Now, a lot of people try to trade for this. Very difficult unless you know what you're doing, and you really need to be very, very clear on the way you do mean reversion. I've said it's kind of entered into a zone. The reason we got that zone is we went all the way back down to 2002. We can see the spiking here. So it's hit an area or a box where you expect it to find some kind of resistance. It started to drop off a little bit, and we are moving now down towards the 107.50, which we know holds probably some orders. So what we're looking for this week is something like this. Drop, 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 fall through. Rally, 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 rally. Ideally, it comes back to something like a just underneath 108, kind of 30 or something, and then we drop back through. And that allows the market to go up because at the moment, no one's pulling out of cash. It's just been cash is king. Maybe now it's stock market's ready to ramp a little bit further before it possibly falls back down. Move over to gold. I mean, if the US dollar is weakening, might be okay for gold. Not seeing any signs of buyers in here. Once we broke through that trend line, which had been holding for a little while, it really was all over for gold. It fell drastically through these levels. Could still go easily down to the 1670 zone of demand. I don't know if it's time to call the bottom on gold, but it is starting to appear into August. It's a bit of a seasonal. We'll keep watching it at this stage, not much. Move over to oil. As we mentioned, oil has been dropping consistently now for the last couple of weeks. We fell down to the very important level of 95, basically. So that's a very key zone didn't quite break through, created two kind of spike candles, found buyers. I could see the oil rallying and then possibly reselling back off. I don't trust it in terms of its rallies here. Some people want to buy oil, fair enough, but I could see it easily go 104 or something like that and then move back down. If you scroll into the smaller time frames and you look at it, the reason why that makes some sense is, think about it. There's probably been some orders here. It went down, busted those, pulls back a little bit, rallies, potentially finds sellers. That would make some form of sense this week. Good luck in oil though, it's going to be tough. Move over to Tesla while it's waiting for the news, isn't it? Look at this consolidation. Just getting squeezed into a tighter range here ahead of earnings. Will it break to the upside or the downside? We don't know yet. That's probably a guess unless you really know something about it. But certainly it's sitting on the volume profile middling area. This means that this is where all the orders are sitting. I would probably guess it either goes to a level of support or to a level of resistance before the earnings result, most likely the resistance based on the current price action. And then we're sitting there, we find out what the announcement is, and potentially we move through or backwards. It's going to be a big week, guys. Tesla coming through. Apple's very similar. Here's the downward trend line that we got busted last time. Then we saw the recovery to the downward trend line and then the resell off. It's rallied back up next week. So not this week coming, but the week after is Apple earnings. So will Apple be able to get any higher? It certainly looks like it's trying to, or it's got a little bit more legs in it towards the bull side. Maybe if it breaches through here, it has a little bit of a rally. Apple has been, I've got to say, one of the most strong, like that's strong stock. It's only down 17.88% from the top. It's held very, very well up until recently. And realistically, it's looking okay here on the charts. Trough, peak, higher trough, higher peak, higher trough, at this stage, still finding buyers overall. XLY, XLP, this shows us a little bit of risk on, risk off. It's consumer discretionary versus staples. As you can see here, discretionary doing all right, staples doing medium at the moment. They're kind of holding each other. I would guess that this is still the same rotation that we've been currently seeing, which is mostly technology stocks, mostly risk on stocks, slightly outperforming any of the defensives over the last couple of months. And this is showing us that case. Let's move to the DAX. This is the German market, still holding the lows. Nice strong wick purchasing, not through 13,000 yet. Could easily see it move up to 13,000. If it breaches through, 13.4 becomes the next level, and then maybe we find reselling at that zone. That's probably going to be the story of a lot of these charts. When you look at them, it kind of looks like accumulation bases. It looks like it can rally. Don't question too much why it's rallying, other than if you believe it's super bearish, maybe this is a great opportunity for you to potentially start thinking about the bearish side, but how are you going to take it is the question. And if these things do rally, where's the most logical points? Back into these resistances. So we're starting to move up. Certainly the DAX looking a lot better. Same thing with the Russell 2000, the small cap companies in the US. Nice little rally there on the Friday session. Real potential here for it to at least go back to around that 177 zone, hit the trend line, and then potentially find out whether the bears are ready to take back control on this market. So that would be a good little level to be looking at for a day trader over the first sessions, and then we'll update it as that goes. Move over to the Nasdaq. You can see here the first trend line was broken. It actually came down and perfectly hit that. It's then created a double bottom, and I wanted to show you the double bottom because we've got quite a few gaps left on these major markets. So we still have a gap here on the top side. That's where it closed and then opened at a different price. And we have one that we left on the Friday session as well. So if we scroll down here and we take the distance of what this would be, which is the double bottom, and we extrapolate that out, it proves pretty well back to the top. So it proves pretty well back into this top, filling that gap that we've got here. So it's a gap fest. Gaps everywhere, guys. And this would fill this gap. So the most logical conclusion is probably to try to fill this, potentially take out the high. If I was just thinking, logically, take out the high, ramp people into this type of position, and then if the market is going to go short, wouldn't this be a perfect place for them to short it? Does that remind you of anything else? That's just more thinking about the chess, but does it remind you of anything else, in previous times where we saw these types of ramps and then dumps? Certainly, it could be. And then of course we know that we'd be leaving that gap behind down here. And there's also on other markets such as the S&P gaps there. So at this stage, looks like it could be ramping. Be very careful of this fill this week. I'm watching that very carefully. And whatever this rally is at this stage, I'm not sure I trust it. It's more of a day trader. Be fast, be patient, react, of course, don't predict, and then just basically follow the flow, but always have the protection in place. That's the kind of way I look at this market at the moment. Let's have a look at the S&P 500. Here's the downward trend. Obviously, we've been talking about this for a while. The gap is higher on the S&P, so to fill this, we would need to move a little bit higher. We basically need to get back into this zone here, which is around 4,020. Is that going to be our high? Fill that area, kind of make a move into this zone, go through, make a move, and then what? Possibly the downside. Certainly at this stage, the rally does seem to be there. It does seem to have buyers. And the reason we say that is because this level, which was our defended zone, is so strong. Let's talk about the trigger points. So last week was pretty good. I've got to say 37.40. This area that we've been talking about, the defended area, held them again. They actually liquidated a lot of stops behind here. It was very sneaky by the street. And as soon as they liquidated, a lot of shorts would have entered here accidentally. And then that's because they weren't being patient, unfortunately. And then we ramped. And that was a big shift. Like in only a few days, all the negative news. And then all of a sudden from the low, you're ramping around 3.39%. Nothing to sneeze at. Now we enter the 38.80 zone. So I've got 38.69 here, but just remember 38.80 was where it all began. That's where we started to see those shorts come through. It's short number 1, short number 2, short number 3, and 4. So these 4 shorts most likely hold what we call supply. If we breach that, we probably trigger a bit of a rally, what I would call a short squeeze. Can that rally sustain to something like a 4,020? Could be kind of cool. Obviously, we'd expect pullbacks through that, but that would be a very logical conclusion. Maybe that's possible. 38.80, very important zone. Obviously, this week for the bears, you push through this defended area, you actually get a daily close or a 4-hour or better close below it. Well, we all know what happens next. Big fall off, possibly the 3,500. Still got targets down there, and I still think that's very possible. But just remember these levels. It closed at 386. Funnily enough, where was the maximum pain for the Friday session? This was the big options expiration, 386. So while max pain shouldn't be used as a target by itself, if you're heavily below max pain and you see a technical buy, that is, you see the switch, maybe it can help strengthen your confidence in that area. So all these poor bears that got in last week, they got absolutely smashed on the Friday, and that's just unfortunate, but it's the reality. Bitcoin over the weekend holding its own as best as possible. We've seen this drop a lot during weekends coming into the next week. 21,200 probably needs to bust through 22 to really start to show those buyers. And maybe it's time again for Bitcoin to show the squeeze as well. Supply up here at 23, 22 bust could push a 25 or even 26 number for Bitcoin. Things are improving, but not really under the hood. It's just more of a everybody's feeling a little bit different. So this is the type of sentiment change we see happening, and hopefully most of you don't fall into the traps, and just really keep a level head and have that patience as much as possible. If you haven't already been following us over on Twitter, come and join us at FX Evolution. We're posting a whole bunch of extra charts there. Join us in the Discord community as well. We've got 10,000 people in there. Private Discord community if you're interested in more private pre-open streams where we go through structuring into the markets. Link in the description. And of course, for the week ahead, we do have some news. Though it's not really about the US, it's other central banks around the world. We've got monetary policy meeting minutes for the odd on Monday. Then we scroll down here and we've got CPI coming out for a bunch of countries. The Bank of Japan outlook report could be interesting. ECB press conference for Europe, of course, and the monetary policy statement. And then we scroll down. The only other bit of US news we have is the Flash Services PMI, which comes out 9:45 New York time on Friday. So really this week is focused on earnings. What do the banks do? Do they continue their mediocrity? Does the market even care? Does the market just go, oh, that's better than we expected? Does Netflix beat? Does Tesla beat? And then ramp into potentially some massive earnings in the week after, which is going to be the big tech stocks in the US. Is that where it all falls over? Let us know in the comments down below what you think. And of course, subscribe, smash that like button if you enjoyed today's video, and we'll see you in the next one. Bye for now.